Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's co-founder of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
I am doing amazing. How are you doing?
I am doing amazing as well. Always a pleasure to see you because I know you've been so extremely busy. So thank you for always coming into the studio to do the shows, if you will, taking the time to do so.
Well, now it's a lot easier because now we have the studio in my office here. So we're literally, I just got done seeing a client, get to come in here. It's awesome. It's easy.
Yes, I know, because you're juggling a lot right now.
Oh my
Back and forth.
Yes.
Absolutely. So obviously, Stewart, you're seeing a lot of people in the office, like we mentioned. Let's talk about your different locations just for a moment, because you're growing.
Yeah, I mean, it's been tremendous. I mean, the show's been awesome at bringing people in. I really want to thank all of the people that have come in as a result of our show. I think people have really connected with it, and some haven't, obviously, with some of the messages I've heard. But, you know, it's been awesome. I mean, we have an office in the West Valley in the Sun City, Peoria area. We have an office in North Scottsdale, and then one down here in Tempe where we're filming. So I think it's been nice and convenient for people to come in.
Sure, absolutely. Stewart, what are some of the concerns that you're hearing more than others right now?
Well, I think we're seeing a bunch of craziness going on in the markets with, obviously, Afghanistan is a substantial issue, you know, how that's all going to, you know, wind down. We have volatility issues and also taxes. I mean, people are really, really concerned about, you know, taxes increasing. But I think more than anything, I think people are really getting a sense that we're coming to an end of this bull market. And, you know, technically we corrected back in March of last year in 2020. But, you know, most people kind of sense it as a continuation of the previous stock market. And we have a slide that I want to show you, which is the S&P 500. And what this will show you is basically how high we are in the stock market today. And the one thing I want to show you on this slide is that we're at an all-time high. You know, you take a look at the far right side of the screen, and we're at the highest point in market history. And if a lot of people really are concerned that maybe it's going to fall again like it did in 2000 and in 2008, and people just want to know that they're going to be okay.
Sure. They want to have peace of mind. So basically, I should ask you, Stewart, how do you help someone put guardrails up so that just in case things do shift again, that they'll be protected?
Well, you know, it's been a really tough argument because a lot of people have had their money in their 401k in an S&P 500 fund, there's some really great companies here that are very passive S&P 500 funds, and they've done an amazing job for the last 12 years. But remember, a blind chicken could have done well in this up market, right? It's when we start to see this volatility that really tests people. And you know, people realize that if we see the same corrections that we saw in 2000 or 2008, which is a 50+% correction, a lot of people aren't going to be able to tolerate that and handle that, or just not be able to sleep at night. So some of the guardrails we have is that we have some of the great money managers. We have the largest money manager in the world with a really neat exclusive relationship with us. We also have an algorithm money manager that basically says when the market looks good, they hit the gas. When the market looks bad, they hit the brakes. And you know, a lot of people don't know when to hit the gas or when to hit the brakes. And you know, I spend my entire day with clients. We're doing planning, tax planning, reviews, consultations. You don't want me picking your funds for you. And what I mean by that is a lot of people are used to sitting with their advisor, and the advisor says, listen, I really like this fund, or I like this stock, and I think we should buy it. And what do you think? Well, here's the thing. You don't want to know what I think, because listen, I have no idea what's happening. You know why? We have some of the best money managers in the world watching. And I'd much rather rely on them, who are watching 24 hours a day. If you are dealing with a financial advisor that's picking the funds for you, I would say get up and reconsider it, because how the heck are they going to be able to move you out of this way if they have this super unique portfolio that's unique to you? If the market starts crashing, what protections are in place? And if they have hundreds of clients, how are they going to move you out of the way in time? I rely on an entire team of money managers to handle that for us.
Absolutely. Stuart, we did have a caller that called in and they'd like to know what exactly is balancing a portfolio and is it necessary, tying into stock market talk?
Sure. So balancing a portfolio historically has meant that if a client has a 60-40 balanced portfolio or a 30-70 conservative portfolio or whatever, typically quarterly, what happens is the computer just generates a rebalancing to make sure that if one portion of the market does well and the other one does less well, they equalize them again to those expected percentages. Now, normally, that's been the way people have done it, and it has made sense in an up market. The problem is, in a down market, we've identified 6 distinct stages in the economic cycle, and during each of those stages, there are different investments that do well. So just think about the logic of this, Cynthia. If we know for a certain that we believe with a high degree of certainty that the stock market is about to go into recession, it's going to correct, does it make sense to be in a full equity portfolio hitting the gas when you know you're going to lose? I'd make the argument that if you can't tolerate that volatility, it's absolutely the wrong thing to do. And some of our money managers have algorithms that are designed to basically say, when we are in expansion, we basically hit full throttle. We go into this very aggressive posture. However, when we start sensing volatility, we pull out of the way. For example, during the COVID drop of March and April of last year, of 2020, the stock market lost 32% or so. Well, we have some portfolios that saw 7.5% loss, and one of them was at 9.6. We have portfolios that are designed to never lose past certain drawdown limits. And what drawdown limits are, Cynthia, is what you're willing to lose, what you're comfortable losing. And I think oftentimes advisors don't have that conversation with their client of what they're comfortable losing.
Sure, that makes sense. Well, Stuart, I know that we have a very special offer to present to the viewers at home today. Let's talk a little bit about what that is and then open the phone lines for the very first time.
Sure. What we're offering today is a complimentary portfolio review. So if you give us a call at 833-652-7829, what we'd be glad to do is give you a second opinion on what kind of risk are you taking inside your portfolio? What kind of fees are you paying? And what kind of portfolio do you have? Do you have the kind of portfolio that is going to move out of the way if something bad happens? Because as we start getting to the end of this bull market, you really want to make sure you have a plan in place. And we can let you know whether or not we're comfortable with your plan.
And Stuart, who would benefit the most from taking advantage of this opportunity today?
Well, listen, if you're 58 and a half or older, and nearing retirement in the next 10 years, I think it's crucial to give us a call. I think it's really important to give us a call because, listen, a lot of people will say, listen, I don't want to call. I don't know about this guy on the TV show. Give us a call. We'll give you a second opinion. We'll let you know whether or not you need to do anything. Because oftentimes we see people that are, have really good portfolios in place, and we'll say, listen, I think you're perfectly protected. But more often than not, people have more risk in their portfolios than they really expect. They're paying more fees than they expect. So we want to just let people know with our portfolio x-ray what's going on in their portfolio.
Yeah, absolutely. Well, Stuart, thank you so much. To the viewers at home, the phone number to call is on your screen, and that number is 833-652-7829. We know you have a lot of questions about how to plan properly for your retirement. Stuart is offering you the complimentary consultation. All you have to do today is pick up the phone and call 833-652-7829. Now, we have to take a very short commercial break, but don't go anywhere. When we come back, I'm going to talk to Stuart a little bit about inflation, so you're not going to want to miss his thoughts on that. We'll be right back.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today, talking about such important topics all surrounding retirement. One thing I would love to talk to you about in this segment is inflation. What exactly is inflation?
So inflation is simply things getting more expensive, right? So a lot of people like the idea, for example, of increasing the minimum wage. But what they don't understand is that when you start increasing wages, things get more expensive, right? So if hypothetically they're paying $12 an hour at the hamburger store, and then they're forced to raise it to $15 an hour, well, you may not be paying $2 for a hamburger anymore. It may go up to $5, right? So the increasing cost of goods is what inflation is.
Okay. I have to ask you a question. What can people do to protect themselves from inflation?
Well, a lot of people have historically moved to precious metals. And so we're seeing a lot of people advertise that they should be buying precious metals on these services. Quite honestly, it's marketed mostly towards conservative audiences. And we'll see a lot of these shops that are offering gold. The problem with that, when you buy physical gold, it's really, really expensive. You've got these sales guys that are charging 15, 20% below spot, which means it's a 15 or 20% commission to them to buy. And oftentimes you have to pay that same 15 or 20% to get out. So it's this really, really expensive proposition to handle. So for us, we don't really see that makes sense, because basically we can buy the same gold in the form of an ETF for 0.25% a year. So why would you be willing to pay 15 or 25%, to get in and out of this when you can pay just pennies on the dollar compared to that? It's just a very inefficient way to do it. But some of the tools that we use are just proper money management, right? So a lot of people are upset with the government spending all this money on stimulus programs, on all of these different programs. Now remember, they benefit the market. The market's V-shaped recovery from COVID is 100% due to the fact that the government is dumping now $8 trillion into the economy. Remember, back in 2008, 2009, when we had the financial crisis, Obama dumped $800 billion into the economy and people were up in arms. We're talking about 10 times that amount now, right? So we're just printing money at this point. So our dollars are going to become worth less. And, there's a lot of conspiracy theories about, China's influence on devaluing our dollar. And some of them have some pretty substantial merit. For this conversation, I want to talk about what we can do to keep up with inflation. And I think first and foremost, you don't want to play scared, but you do need to have a plan. And I think that's why it's really important to make sure you have a money manager that looks at everything, that looks at where we are in the current economic cycle. Because if all you're doing is buying the same 5 mutual funds and they're quarterly rebalancing based on your percentages, you're not keeping up, right? That's not an adaptive strategy. We have identified 6 very distinct stages in the economic cycle where there are different investments that do well in different periods of time. So you need to make sure, if we're going into recession, you understand how to benefit from that recession. If we're in expansion, you need to know how you should benefit from that and make sure that your money manager takes into consideration all those factors.
Stuart, I have to ask you, how important is it for someone to be working with a fiduciary, speaking of best interests, if you will?
Yeah, I think, quite honestly, Cynthia, that fiduciaries are a minimum. If you're dealing with one of the old school brokerage firms, I just don't see the value in doing that relative to the fiduciary relationship. Now, here's what a fiduciary is. A fiduciary is obligated to disclose any undisclosed conflicts of interest. So they have to make sure that they put the client's interest first. A lot of old brokerage houses get paid by the fund company. So let's just say that, mutual fund A is very dominant in your portfolio. If you see, mutual fund of blah, 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 and you tend to see 5 or 6 or 8 of those in your portfolio, and you see an A, B, C behind it, well, those are loaded funds. And guess what? Those are paying your advisor and their brokerage house commissions and fees on the back end, separate from what you may be paying them. So you just want to make sure that your advisor works for you, they're looking out for your best interest, and not just their firm's best interest.
Stuart, you mentioned the word fees. Let's talk a little bit about that. Let's go diving into what the portfolio X-ray consists of. How do you do that for your clients?
Yeah, so the portfolio X-ray looks at not only the fees that you're paying the advisor themselves for advisory fees, but what are those fund fees? What are those 12B1 hidden fees? And, a lot of people have no clue. I had a client that, was very clear that, hey, I'm paying a 1% management fee at his, he had his money with a 401k, and then they moved it from a 401k to an IRA with the same company, big company. But what happened when he made that move is they put his funds into these proprietary funds that they own. So not only do they advise you on it, they own the fund company itself. Well, those funds went from paying an average of 0.3% to 1.2%. So not only is he paying a management fee, he's using funds that are 2 or 3 times as expensive as what he had before. So you would just want to make sure that there's no trickery going on, that there's no unnecessary fees. And it's not to say that your broker's a bad guy. That may be all that they have to offer. You just need to make sure that there is none of those conflicts of interest in your portfolio.
Well, Stuart, I know that you have a very special offer to the viewers at home today. Let's talk a little bit about what that is once again, and then reopen the phone lines.
Sure. If you just give us a call at 833-652-7829, what we'll do is take a look at what kind of hidden fees are inside your portfolio. We'll also look at the risks that you're taking in there, and we'll take a look at any tax concerns we have regarding your portfolio for the future. All you have to do is give us a call, 833-652-7829. We'd be glad to take a look.
Stuart, thank you so much. To the viewers at home, the phone number to call is once again on your screen. That number is 833-652-7829. We know you have a lot of questions about how to plan for your perfect retirement. Stuart is offering you the opportunity to come in for that complimentary consultation. And once again, that number to call is 833-652-7829. When we come back from this very short commercial break, I'm going to talk to Stuart a little bit more in depth about diversification, and is that important for you going into retirement? Please stay tuned.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He's co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show we're having today. And obviously in this final segment, I'd like to talk to you a little bit about diversification. Is that important for someone going into retirement? And if so, why? What exactly is diversification?
Well, diversification is crucial. Now, historically, diversification has meant to basically have your money in separate asset classes that aren't all allocated to the same thing. So, for example, people will say, hey, you need to have 10 different stocks or 10 different mutual funds, some stocks, some bonds, some alternatives, etc. Now, that's diversification of your investments. And I agree, it's super crucial. You know, under modern portfolio theory, diversification really is one of the best indicators of whether or not, you can survive a storm if things go bad. But I think the focus on just diversifying your investments is overblown because there are a few other kind of diversifications that really make sense. Let me flash back to the correction that we saw in March and April of 2020. When we saw a 32% correction in the S&P 500 back then, we have multiple money managers at our firm. And just remember that, a lot of people's reality is determined by what news channel they watch, right? And so if you watch one news channel, you believe one thing. If you watch another, you believe in another. You see the world differently based on how it's presented to you. And especially with cable news, right? Now understand that money managers have that same sort of ability to be influenced. So if you have a money manager or a financial advisor that's picking all the funds for you, he sees the world only through his eyes. Does that make sense?
Absolutely.
So if he only sees it one way, well, you're going to live or die by his opinion of the market. And so we don't believe just in a diversification of investments, but also a diversification of perspectives. And what we mean by that is that not only should you have a truly diversified portfolio, but that should also include multiple perspectives in your portfolio. So we have multiple money managers. And what if they get it wrong? Let's flash back to what I was talking about in March of 2020. One of our money managers, who's been one of the greatest money managers for our firm, been unbelievable, an algorithm money manager, they went defensive because remember, going into the election, a lot of people thought that, hey, if Biden won, the market would crash, right? Higher taxes, higher regulation. But if Trump won, there could be riots in the street, on all kinds of, issues.
Sure.
So people saw defensive issues, and some of our money managers are more concerned with loss than they are with gains, and so they went defensive because they just wanted to avoid any downside. Well, one of our other money managers believed Biden would win and it would benefit the country financially because there would be all these stimulus bills, and they were right. So if all your eggs are in one basket, meaning in one perspective, what if you were the one that got it wrong, right? Is it worth, risking everything you have on one perspective? That's why we don't do that. We make sure that we have people's money in multiple perspectives so that if things go wrong, they're not going to, be completely, out to dry there.
Absolutely. Stewart, do you ever recommend that someone test drives their retirement?
Yeah, I think it's really important to, make sure that you have someone you trust that can do a real analysis, a cash flow analysis of everything that's going on. You want to make sure that you can run it through all the different scenarios, different Monte Carlo simulations. What if the market crashes? We have the ability to back test your portfolio to see what would happen if you owned that in 2008 and the market corrected. What would happen to your portfolio? And a lot of people, the first thing I ask them is, how much are you comfortable losing, right? Most people are so worried about gaining money right now, they're not thinking about the losses because 2008 was a long time ago, right? It's 12 years, 13 years now, what? 12 years. And people have forgotten. They're desensitized to this amazing growth we've had in the market. So what we do is we backtest and say, hey, are you willing to lose 40% of your portfolio? Because that's what it's showing in your portfolio. And if people are surprised.
Yeah, absolutely. Stewart, what does it feel like for you when you can tell someone that they can retire today if they want to?
Yeah, I just had that talk with one of my favorite clients on the planet. He's actually back in Chicago. I would say he's a third generation client of ours, but that sounds a little goofy. But his father, his sister, and then he are all clients of ours. He's just scared. He has this great pension, great 401k. And, you know, he's actually really, really young. He's going to be 55 years old. And understand, when you retire, there's a lot of things that you have to consider, because what a lot of people don't think about is if they're under 59 and a half years old, they may not be able to have access to their 401ks, right, until 59 and a half. You know, but with him, we were able to use this rule called the rule of 55 that allowed him access to it with a one-time distribution without any sort of penalties. And if you're looking to retire, if you think that that's imminent, you need to be able to test drive that plan. And if you don't have a plan, you need to give us a call. Just give us a call at 833-652-7829. We'd be glad to give you that test drive to do an analysis of your plan and let you know whether or not we think you're ready.
Stewart, is it still a surprising number of people that do not have a plan in place for retirement?
Oh, absolutely. I mean, it's funny. I had a doctor that we were scheduled to see yesterday, and she didn't make it. She canceled for a second time. And I can't keep seeing people that are canceling their appointments, right? They have to make it a priority. A lot of people put their clients first and don't put themselves first. When it comes to retirement, you need to put yourself first. And that even comes to, when it comes to giving money to the kids, right? Yeah. Sometimes I have to have those hard talks with our clients of, hey, you need to stop this, or you need to do this. But if you're not making yourself a priority, then, you're really missing out, and retirement's going to be rough.
Absolutely. Well, Stewart, with less than a minute left of the show this week, any final tidbits of advice that you would like to share? Yeah,
the one thing I'd say is don't be afraid to give us a call. Make sure you have a plan in place. And if it's not with us, make sure it's with somebody. Make sure they're a fiduciary. Make sure they look at taxes. Make sure they look at your estate plan. If they're not looking at everything, you're missing out.
Stewart, thank you so much for another amazing show this week. To the viewers at home, most specifically, thank you for spending time with us. That number to call is 833-652-7829. We know you have a lot of questions about tax planning, how to plan your perfect retirement. Stewart is offering you a complimentary consultation just by picking up the phone and calling in today. Be safe, be happy, be blessed, and we look forward to seeing you back here, same time, same location, 1 week from today.